welcome everybody for my new segment, the legal series. Today I have Todd Jarvis here. He is going to be teaching us a 6-segment series, everything that is legal that has to do with your business, regardless of you just starting out, through contracts, through maybe expanding in the future. So I'm gonna read his bio just a little bit so you can give you a little background. So Todd Jarvis practices here in Tucson, Arizona. He serves entrepreneurs and families because he is committed to helping everyone bring their greatest gifts into the world. He knows mastering the foundational aspects of business building, create the conditions of success, and open the door to the impact and freedom we want from our life's work. Todd graduated from the University of Arizona College of Law and earned an MS in genetics, concentrating on bioinformatics. Concurrently with his law degree, he focused his studies on business, intellectual property, and estate law. He is licensed to practice in the state of Arizona and before the U.S. Patent Bar and Trademark Office. That's amazing. I didn't know you actually studied genetics too. That's cool. So what got you started to do law and do genetics?
Okay, so basically I was, before law school, I went to law school a little bit later, I guess you'd say, than most people do. I was in my late 20s. I was raising a family through undergrad and such. And so I was working full time, raising that family, getting my undergrad done up at Brigham Young University. And so I was working for a tech company, Henry Schein's, they're a dental distributor, and I was working for in their software development and tech arm. And so I was doing a lot of management and working, building out departments. I was kind of the go-to guy when it came to starting new projects or starting new departments. That's just kind of my personality. I have a very strong entrepreneurial spirit. I love starting things, growing things, and putting good solid foundations to make sure those things succeed. And so that's what really kind of got me interested in thinking about law. Is I was like, hey, I could work on one business, or I could go be an attorney that serves business owners and work on a bunch of different projects with those business owners. So that's what got me thinking about law, and that's why I kind of went that way. Being in the tech industry, that's kind of where I had that hard science and tech background, and why I was studying bioinformatics at the time, which is kind of a marriage between molecular biology and computer science, computer engineering. And so when I was talking to the law school counselors, they're like, no, stick to your hard science. It'll open more doors. You can take the patent bar. And if you work with business owners, it'll help you speak the speak, right? You'll be able to understand their technology and understand the foundations of their businesses and such. So, which I found to be very true. So I was grateful for that guidance. And so that's kind of what got me into law. I always wanted to be on, I call it the happy side of law. We're building things, we're growing things, we're not tearing things down, right? Mm-hmm. We're working on businesses. We're trying to help business owners serve the people they love, serve their clients, and do it in a way that will help them take the risks they need, but have that sure foundation so that they can explore those risks, right? So they can have that confidence to move forward and what it takes to be successful. And I think it was Thomas Edison, great risk, great reward, right? Mm-hmm. High risk, high reward, low risk, low reward. So that's kind of why I'm here and why I'm doing what I'm doing. So yeah, that's a little bit about me. And I've been practicing for going on 8 years now. Here in Tucson, I worked for a regional firm, for about 6 years, and then I started my own firm here. I saw a couple of things I wanted to change about the way that I was interacting with clients, the way I was serving clients, the way that attorneys currently approach and work with their clients. I think there's a better way of doing it. So I'm working on establishing that.
Nice. I love that, because I know there's kind of a stigma behind lawyers. I used to do bookkeeping and accounting, so there's always this stigma about accountants too. And so when people meet me and they are like, you do accounting? You don't seem like the type that does accounting. And so I'm so excited for you to be on here. And I love that you're multi-passionate as well. Perfect for my audience. We all have a lot of things going on. And some of my audience are freelancers or just kind of starting a side hustle, and some are actually, full into their business, ready to grow it. And I wanted to start the series mainly because I've seen the bad aspects of business owners from the finance side, or like the bookkeeping accounting side. And I really want us to start talking about, especially for today's episode, is why is it important to protect ourselves and create an LLC or incorporate?
Okay, great. Yeah, I think that's as far as the why, right? The big why. I think that's a great place to start. That's fantastic. So I know I run into quite a few. You mentioned that there's some freelancers you work with. Maybe people start something on the side. They're just kind of dabbling and thinking about owning a business, but they still have their core income at the time. Or there's some who just jump straight in, right? So I know a lot of times, especially those who are just starting out or may not be making, have a ton of revenue up front, and who are just trying to experiment with business ownership. I know a lot of times they may get some counsel or some advice from CPAs or other professionals, even some attorneys that say, hey, you don't need an entity. You're not making enough, right? Or maybe you're not big enough. You don't need an entity. I disagree. I think there is always a need for an entity. And a little bit about the why I feel that way about it is, one, you have, like I said, it gives you, okay, so the purpose of the entity, right? We're setting up a boundary, right? We want to separate your personal life from your business self, right?
Mm-hmm.
And put kind of boundaries around that business. The reason we do that is because there's two things we want to protect ourselves against. One, we want some liability protection, and two, we want some tax protection. And an entity is a way to do that. And we all, no matter how big or small we are, we can all benefit from that. We'll get into both of those in a second, but another thing I want to say a little bit goes back to what I said about the risk. Having a business entity, because they give you these two protections that we'll talk about in a second, they give you a little more confidence, right? They give you that feeling of, I'm taking this seriously, therefore you're going to act more seriously in the business. I think a lot of times when people say, oh, you don't need to, you're not big enough to have an entity, I'm of the opinion that, well, when I work with a business owner, I don't want them to feel like I'm trying to keep them there, right?
Mm-hmm.
I want them to feel like they're growing and that they have room to expand. And then we're thinking, well, when am I big enough? When does this happen? And what's that magic, line that I need to cross before I'm a business, right?
Mm-hmm.
So again, there's a little bit of the psychological aspect to it, to where you'll take yourself a little more seriously. And then let's talk a little bit about those two liability protections we talked about. We're setting up these boundaries around our business. Liability protection, we're talking about there when we talk about liability, it's basically people who can take things from us, right? Things that we can't necessarily control either, that can affect and jeopardize our business or our personal life, our home, our income, that we need to provide for our families. So if we put a boundary around the business with it by establishing an entity, we can kind of safeguard from what we call inside and outside liabilities. Okay, so inside liabilities, we're talking about inside the business. So we're talking about things that might happen, that the business might do, that causes a problem for us to deal with, right? Causes us to owe someone else some money, maybe the business to owe someone some money. So an example of that might be, a client sues you, or a client trips and falls on in your office, and now they are looking to get coming with a personal injury lawsuit. Maybe you have an employee that you're working with, and they are coming with a claim, an employment law claim or something like that. So those are all inside the business. Maybe an employee gets in a car accident while they're delivering something for the business, right? They're on the job and they get in an accident. All those are inside the business. and we want to keep them in the business. We don't want those leaking out to our home, to our family, right? And so so an entity allows us to do that. It kind of traps, put a boundary around that business and traps that risk inside the business.
I like that you mentioned that. Just from my bookkeeping background, there's a lot of freelancers who do like virtual assistant work or they freelance writing. When I first started out, I did bookkeeping as freelancing until I decided to get an LLC. And just from that aspect, you may not have employees, you may be by yourself, but the work that you do might affect somebody else's business or life. And you really want to keep that separate. Especially if they do sue you and you don't have a company that you're working under, they can go after your personal assets. Isn't that right?
Yeah, if you're working as a sole proprietor and you don't have an entity, the government, the court, everybody, they don't see any difference between your house and your business bank account or your business computer, right? Anything that you may see a separation, but there is no separation. It's you, everything belongs to you. Therefore, those clients that you hurt, whether intentional or not, they can come after everything you own, and they can use those assets for that. Exactly. I mean, those are great examples. So the outside liabilities, those are things that we do in our personal life that cause a liability, cause a risk, right? Cause damage to somebody else. And we don't want those things affecting our business and our livelihood, okay? So if we get in a car accident or your teenager gets in a car accident and your insurance isn't high enough to cover the judgment, and they come to you to collect for the rest of that judgment, you don't want them to be able to take assets from your business, because that's going to, not only is that going to affect you temporarily as far as you've lost those assets temporarily, but it's going to affect your ability to keep your business running. If you get, another example is getting a divorce. I had a friend who got divorced, and her ex-husband was like, I deserve half of that business. And so that was an outside liability. So there's different things. We want to make sure that, and a lot of this we can't control, but even things that you do control and you do cause, you want to make sure that there's that separation. And that's what an entity allows you to do. That's the big why. Why do I want an entity? It's because you want that separation. You can create a separation and you can protect your assets. So why not take that step and do that? And it's just a good form of protection and a good form of, again, giving you that confidence to move forward with your business and to take more risk than you would if you knew your house was on the line.
Yeah. Or even if you didn't have a house, let's say you're just doing this side gig to pay off debt and you're renting, but you have a car, like,
Right.
that's when you already are barely making it by, you don't want to take that risk of all of it being gone when you could protect it and have it separate and with just the business. And it's very rare that things happen, but this is where we're trying to protect ourselves, right? So let's talk about the different types of entities and what uses are best for them. Because I know I get a lot of questions about LLCs, S Corps, C Corps. From the majority of my audience, C Corps aren't really a big thing, but we can talk about them. And I'm not sure if you can speak to it, but I think you can. Taxes and how it'll affect your taxes.
Okay, yeah, that's great. So yeah, there are two, for small business owners, there's pretty much two forms of business entities you're going to look at creating. And we'll talk about in a second what you would consider when trying to decide which is best for you. And taxes is definitely one of those things, one of those deciding factors. So the two we're going to talk about are LLCs and S Corps, right? An LLC it stands for limited liability company. So it's a business entity, and the great thing, they're really popular now, right? A lot of times talk to people, small business owners, majority of them are creating LLCs these days. Now, whether they're doing that under the guidance of professionals or not, I don't know, but a lot of the attraction to the limited liability company is the flexibility it offers. And what I mean by flexibility, it means that you can kind of create that business to operate in very unique ways compared to where a corporation, an S corp, has a lot more stringent rules to it, and doesn't have quite as much flexibility in how you can change how it operates. We'll talk a second about what I mean by operating and what kind of flexibility there is. But with a limited liability company, it does create that shield, right? A liability shield, because you have those boundaries in place. It also offers protection from outside and inside liability. So you've checked those boxes. And how a limited liability company is set up is it's made up of owners who are called members and managers. Okay, so managers are the people who actually make decisions and run the business on the day-to-day business, and the members are the ones who own the business. Now, to tell you the truth, especially with small businesses, generally they're the same people. All right, so most of the time, if you own an LLC, you are also the manager of the LLC. So you're the member, the owner, and the manager, the person making all the decisions and running the business. If you have partners, you can both be members and both be managers, or if you could be more creative and have both of you be owners, members, and maybe only you are the manager, right? Their role is a little different. So they're kind of doing more of a passive investment in the business. They're kind of helping you with the money and such, but they're not making day-to-day decisions in the business. So there's what I mean by a little bit of flexibility you can have with an LLC. Another thing with an LLC, that flexibility that it offers, is that so your membership interest, that's the ownership percentage that you have in the business, you can be creative with how you split that up. So you can split up between you and your partner, 50-50, 70-30, or any other incremental changes into how that's split up. But now you're probably thinking to yourself, well, you can do it at a corporation too, right? And you can, but what you can do with an LLC is you can not only decide how much ownership you have between the partners, you can decide how much each partner, what percentage of the expenses, write-offs each partner gets versus how much income each partner gets, right? So you can kind of, what that does is it helps people, maybe one of the partners has, for tax reasons, they really want the write-offs, they really want the expenses, and they want some of the losses attributed to them, where the other owner needs the income and such. So that's kind of where you can get creative. You can distribute the profits and losses in unique ways. That's a little advanced tax planning, but just so you know, it's there, and an LLC makes that available. Where in an S corp, it's not. All income and expenses and losses are all distributed equally according to your percentage of ownership. Well, I don't want to get quite to S corps quite yet. So with the LLC also, there's some things to think about. You may, if you start looking into limited liability companies and the liability protection, you might start reading a little about what's called a single-member LLC. Okay, so that's when only one person owns the LLC. There's only one member in the limited liability company. And you might see some red flags in your research coming up about that. Now, in a lot of states, there are some concerns with that, meaning that some states, the court system won't recognize the boundaries of a single member LLC. It'll say, no, it's just you. There's no other partners. Therefore, there's no boundary between your personal assets and the company assets. So that's a discussion you want to find out about the state that you are going to form your entity in. And we'll talk about where to form in a little bit, okay? I'm going to talk about the entities first, then we'll talk a little about how to choose a location, what state do you want to incorporate in or organize in. Okay, so what you can do to solve that single member issue, in some states, you want to make sure to have a multiple member LLC, meaning that you have more than one partner. And if you're married, your spouse can sometimes be that partner, and then the court will say, okay, you're a multi-member LLC because there's two people in there now. That kind of varies from state to state and such. In Arizona, the single member LLC isn't as big of a concern as it is in other states. But some states have basically written in their statutes that a single member LLC isn't really, there's no asset protection. Okay, so
that is.
It's because an LLC, what it really is, and like the IRS, if you ever worked with an LLC when you start filing taxes and such, so an LLC has what's called pass-through taxation, pass-through income, meaning that as the LLC earns income, that income is automatically attributed to you as the member, as the owner. Even though the money might stay in the business, the IRS and everybody considers it already yours, meaning that the LLC doesn't file its own taxes, okay? An LLC passes through that income to you, and you put it on your own tax return and as income. Like I said, whether you've taken the money out of the bank account to yours or not, it's automatically attributed to you. And so an LLC, basically, it's an expansion on partnership law. And so some states say, it's supposed to be, an LLC is supposed to be a partnership. It's not a partnership here. Therefore, we're not going to respect it as a partnership, as a separate entity. You're a sole proprietor. So that's kind of where they're at. And that's why I mentioned earlier about the flexibility of an LLC and the restrictions and kind of the structure of a firm structure of an S corp, meaning that there's a lot of red tape with an S corp. Like a corporation, you have certain requirements you have to fulfill regularly to maintain that corporation. We'll talk about what those are in a second. But that's why when I work, the LLC owners I work with, if we determine an LLC is appropriate for their business, I will recommend that they basically adhere to a lot of those same red tape structures and requirements of a corporation within their LLC, just so that they're bolstering up that argument that, no, this is a separate business and I deserve the protection of it being a separate entity, being a separate person than me. So that's why, a lot of people, set up their, we'll talk about it in a second, but as far as when you get an entity set up, you're not done. All right. It's not like sit back and, okay, let's go do business now.
No.
we need to maintain that business and maintain those boundaries. And we'll talk about how you do that in a second. Did that kind of answer your question though, as far as?
Yeah, I was just curious, and I'm sure some people in the audience are curious, because if I'm going to go through this trouble of setting up an LLC, but it's just me, I don't have the funding or need the team right now, I'm building up my, cash reserves to maybe grow into a team, why wouldn't you consider me an actual business? So, but yeah, that answered it. But there are ways around it, like you said. So we'll talk more about, what I want to talk about before we jump in is you mentioned about being member managed or manager managed. And for some people who are going to be filling out the paperwork themselves, I know it's easier in some states to do it yourself versus getting a lawyer. Can we talk about operating agreements and bylaws?
Yes. So an operating agreement is the governing document for an LLC. Okay. And what it does, the operating agreement allows you to specify how the business runs, okay? What meetings are required, who the members are, the initial members are and managers are, how much equity do each of them own, how much do they own of the business. It also, if you have a basic operating agreement's okay for a single member LLC, but if you have more than one member, it's imperative to have a good, solid operating agreement. I always tell people that business is about relationships. That's all business is. It's just a bunch of relationships, right? And so you have relationships with your partners, you have relationships with your vendors, with your clients, you have relationships with, any contractors that you hire, right? all these people that you're working with through your business, you're forming those relationships. And the best way to maintain a relationship is to understand the expectations of the relationship, right? What can I expect of you? What can you expect of me? And how we handle those expectations in business is through agreements and contracts. Okay, and an operating agreement is you and your partner sitting down and setting forth those expectations. What can you expect from each other? If the company needs money, how are we going to give it money? Are we going to split that? Can we loan money? Who can make those decisions? If we need a business divorce, we're no longer getting along, how are we going to handle that? And these big what ifs that come along in business, and they always come along, you want to answer those before they come, all right? So you want your operating agreement to handle those what ifs so that when they come up, you can just look to the document and say, hey, we had already decided how we're going to handle this situation. We don't need to get emotional. We don't need to get heated. We don't need to fight about this. Let's just step through the steps that we outlined in our agreement and we'll be okay, all right? So it takes a lot of the pressure off there and a lot of the cost on the back end. In an operating agreement, I really do recommend that you have those reviewed by an attorney, at least, if not drafted, and work with an attorney to get those put together. Just because it can have the consequences can be severe and costly, right? I always tell people, make every decision in your business based on economics, not about morals, not principle, and it's all about the economics, all right? So when you think about it, paying an attorney a little upfront to help you with that operating agreement. Anytime I've seen a partnership have issues that could have been handled by an operating agreement, the cost on the back end has always exceeded what that operating agreement would have cost.
Yeah.
So I think, they kind of say penny wise, pound foolish, right? But just be wise up front, get that done, and move forward. If you're operating by yourself, then the operating agreement isn't as important. You need to have one, again, as part of those formalities, so you can show the court, I've got my record book here, I've got an operating agreement, I've got all of my formation documents, I've got all my resolutions and minutes. We'll talk about what all these are in a minute when we talk about maintaining your business. But you want that record binder is your proof to the world that this business is different. This business is not me, it is a separate entity. And the operating agreement needs to be in there. So that's a little bit, you mentioned bylaws. That is basically the equal to the operating agreement in a corporation.
Okay.
So a lot of the same things. It basically it's the governing document of a corporation. It sets out how the corporation is going to be handled. Let me just look at my notes here real quick, see if there's anything I want to say about LLCs, and maybe we can jump right into S Corps, talk about their structure, and we'll talk about why you'd want to choose between the two. Since we're talking about bylaws, we can just kind of segue into corporations. So corporations have been around a lot longer than LLCs. LLCs became really popular in the 90s. Corporations have been around for centuries. And so corporations, when we say S Corp, what that means, it's a corporation. It's set up just like any other corporation. However, that corporation has filed a document with the IRS we call it taking an S election. All right. And basically what that does is it tells the IRS we're going to be taxed in a different way. We want basically that pass-through taxation that we talked about. Because normally a corporation has to file its own income tax. Mm-hmm. You might hear about this like double taxation of a corporation, right? Sorry, did I lose you? Okay.
No, you're back now.
All right, I'm sorry. So that double taxation, a corporation has to file its own income tax. All the income that's coming to the corporation, it files an income tax, pays income taxes, and then it distributes those to the owners, and then owners file their own income tax, right? So there's that double taxation of income. An S Corp for an S election says, no, I want to be taxed similar to a partnership, where or an LLC where there's pass-through taxation. There's no income tax at the corporate level. It all flows down, and the individual owners file and claim that income on their taxes. Now, the structure of a corporation is set up as shareholders, and they're the owners. They own shares of stock in the company. So that's like your members of the LLC, right? So your shareholders are the owners, and then your officers and directors are the managers of the business. They're running the business. The shareholders are the owners, equity owners, and in smaller corporations, they're going to be the directors and the officers as well. And that's okay. You can have a corporation that has one shareholder who's the only board director on the board, who's the only officer in the company. That's fine. You can do that. And it does not limit the liability protection. Like it doesn't have the same single owner issues that maybe an LLC does, depending on where you organize that LLC. So, and that's because they've been around a lot longer. The case law is more established, the statutes are more recognized, and but with that comes more rigorous maintenance to the business. A corporation requires annual meetings. It requires some states it can be more expensive to establish a corporation. Most states require an annual report to the state regarding the corporation, where a lot of states LLCs don't have to make the annual payment or annual report to the state. Like in Arizona, they don't. LLCs don't have any required reporting past the original formation. Corporations do. But it's state to state. I mean, California LLCs have a really high tax on them. They're paying like $800 a year to maintain that LLC. Yeah. So that's kind of why you kind of look around. Where do I want to form? So corporations, again, it's all about there's more rigorous record keeping, but at the same time, all of the business owners I work with that have LLCs, I recommend and I help them to basically fulfill all of those same recording requirements anyways, because it just helps that argument. Again, you just want to support the argument that this business is separate from you. So by being more rigorous with record keeping, you kind of build up that argument. So even though there's more flexibility in the LLC, a lot of times I recommend being more structured and more strict with the record keeping anyways.
Are you able to speak
and so
oh, go ahead.
No, I'm good.
So are you able to speak to, you mentioned about like S corps, that's how you elect with the IRS and how to be taxed. Yes. There's like news, it's been in like, I think it's been the thing for the past couple years or few years, is getting an LLC and electing to be taxed as an S corp. So can you tell us the difference between doing that versus just doing the S corp?
Yeah, for sure. So an LLC can file the same paperwork with the IRS to elect to be taxed as an S corporation. And that is all about tax savings, okay? And so one reason why, we'll start the conversation on why you would choose one over the other. I guess we kind of already been talking about it, but the tax benefits of an S corporation can be significant depending on the cash flow of the business, okay? And so we know that in an LLC, by default, it's taxed as a partnership or as a disregarded entity. Don't worry about that. It just means that you get the money. So what that means is all of the money that you make in your LLC that flows to you, which is all the net income, all of that is taxed not only as your income, but also you have a self-employment tax right?
Mm-hmm.
That is imputed onto that income. So you have to pay self-employment tax on all income from an LLC. And that's because you're not employed by the LLC, and you actually can't. You're not allowed to be, it's the law to be employed by an LLC that you own, that you're a member of. Okay. Whereas in an S Corp, you're the shareholder, maybe the director, but you can be hired by the company to be the president and officer and being an employee as an officer of the business. There's no rules against that. So what that means is you can pay yourself a salary, okay? And so that salary is taxed as a normal W-2, W-4 employee, right? And so that's a lot, it could be a lower tax rate than your self-employment tax, which can be up to 15% self-employment taxes, right? So so that's where you might choose an S Corp over an LLC, is because you're going to save money on tax bill. And that's great, right? Well, you get to keep more of your money because you're just paying income on your employment wages. Now that wage needs to be reasonable. That's what IRS says. You can't pay yourself, $2,000 if someone in the same circumstance, if you had hired an officer instead, they would have been paid $4,000 a month. Right? You can't just pay yourself $2,000 and say, hey, I'm only gonna pay taxes on $2,000 and then take everything else as a distribution as my shares. So it has to be reasonable, but that really can cut down on your tax liability. Now, LLC, if you take an S election through the LLC, you get that same benefit. Now you can hire yourself as an employee of the LLC and pay taxes as a normal employee on your salary. Okay, so that's where it kind of, so in that way, sometimes that decision between S Corp and LLC can be a little more difficult because the tax decision doesn't always say S Corp. You still have to consider the liability issues and the other costs. If one's going to be a lot more expensive to maintain than the other, S Corp's going to be a lot more expensive than a LLC. Maybe you go with an LLC and you do your best to run it as a corporation, so you afford yourself the same liability protection a corporation would. But that's why when someone is making a decision where they're going to form an S Corp or a LLC, I think it should be a decision that is made between amongst the business owner, their attorney, and their CPA.
Yeah.
So it should be a team decision. It should be a team analysis. CPA should be weighing in, the lawyer should be weighing in, and the business owner should be ultimately making the decision according to their guidance. I don't think in most cases a lawyer doesn't have all the information, and the CPA doesn't have all the information, but together they make a great team. That's why if you do work with an attorney, make sure you work with one that is willing to be a team player, right? You want a relationship with your attorney. You want them to be willing to work with your CPA and have those conversations. Make sure the attorney's not billing you hourly. That's difficult. As a business owner, you want a certainty of cost. You want to know how much is this going to run me, so you can budget it in and things like that, right? So that's kind of how, when you're making this decision, how would you, I think it should be a team decision if you're seeking professional help. Now, with that, some other things to consider. I don't know how many of everybody listening here are real estate investors, but with real estate, a business that owns real estate, that's pretty much that's a no-brainer. It's going to be an LLC. Just the way the taxes work with real estate, and it's not really an operating business. So an LLC just makes a lot more sense that way. So in case anybody had that question, is wondering about real estate, LLCs, it's pretty much a made decision already. Not much to think about there. See if I'm just checking my notes here real quick on
Go ahead.
What else.
I just want to say, I'm glad that you mentioned that it needs to be a team effort in speaking with your CPA and your lawyer including any other partners you have, because the LLC electing to be taxed as an S Corp may have tax benefits, but if you're not bringing in enough revenue to, let's say, have yourself on payroll, you got to keep in mind all those extra costs that might be coming in. I know for some states, if you're going to have employees that, what is it? Why can't I think of it right now? It's the insurance whenever you have employees. You have to have that insurance when you have employees.
Oh, yeah, like
Workers' comp.
yes, thank you.
Thank you. I don't know why I was like I had a brain fart on that. But yeah, a lot of the states require you to have workers' comp, regardless if they just work from home, they're not actually handling things. So that's an extra cost that you have to keep in mind. And keep in mind, like you said, being paid a reasonable salary. So if you can't pay yourself a reasonable salary with the amount of revenue because it's fluctuating, you may want to wait for that election. But all those decisions need to be made with professionals who have dealt with this and understand your situation and how you're trying to grow the business to give you the best advice.
Yeah, exactly. That's you said it better, and it's perfect.
I like to give examples so people are like, well,
yeah.
I know there's some people out there who are freelancers or people who just started their LLCs or, and they're like, I can't afford a lawyer. I don't have a CPA. And it's like, look, I mean, even if you can just get a free consultation to see if you can even work with this person, see what their prices are, I highly, highly recommend working with professionals because like you said, pay that money up front to protect yourself from paying a lot more money down the road that could hurt you.
Yeah, if you have an LLC or an S Corp, you need to have a relationship with a CPA to at least file your taxes, because it just takes it to a different level, and it's worth a couple $100 usually what it can cost to have a CPA, not just a tax preparer, but a CPA prepare your taxes for you. Highly recommended. So those are kind of some of the things to consider when deciding between whether you're going to do an S Corp. And like you said, I mean, a lot of this, you're not locked into a lot of these things. A lot of clients I work with, a lot of business owners I work with, we might kind of put them through we have an objective. We know in the end, they're going to want to invest money from investors, right? We're going to approach some investors, no matter how big or small the investors are, whether it's just a couple $1,000s or if they're looking tens or hundreds of $1,000s. A C Corp is going to be kind of something that the investors are going to want in a lot of cases, but we're not going to set up a C Corp up front, right? That's too much. We want to concentrate on growing the business. So we start an LLC. And then from there, when they're making enough money, like you mentioned, we submit and file an S election. Now they're paying themselves a salary. Okay, now they're ready to approach investors because they're at that point now. Okay, let's convert your LLC up to a corporation. And so there's steps to take. And that's where working with a strategic partner kind of can really help. And things like that. And so that's kind of where, I forgot to be the lawyer up front, right? Didn't have to say this. So everybody knows this, I'm a lawyer. I'm not your lawyer, unless you've engaged me. So just consider through these conversations, as we have this conversation and future conversations, think of me as your strategic partner. Okay, we're trying to get some thoughts and get some ideas out there. And I have to throw that out there. I should have done that up front.
Don't worry, I will have a written disclaimer in the beginning of the video and the very end.
All right. So let's talk about where, if you don't mind. Can we talk about a little about where we should incorporate? Because I know there's a lot out there about, Nevada really pushes it. Hey, come form in Nevada. They do a lot of marketing. Delaware, you hear a lot about with corporations. Delaware corporations I don't think Delaware makes most of its money off of corporations. It's a big business there. Anyways, it's because they're very established, right? They have the most tried and true corporate laws in the world. So someone who's thinking about doing a corporation, Delaware might be something to consider. Anyways, but why would you choose a different state than what you live in? Okay, so a lot of times the state you live in is the right choice. A lot of times, and the reason is because one, it's easier. All right. We'll talk about why in a second. But it can be easier. Sometimes it can be cheaper. But most of the time it's just because there's no advantage to doing it outside your state. But let's talk about when it might make sense. So why would someone in California let's talk about California. Why would someone in California want to maybe incorporate in Nevada? One, we talked about, say they're doing an LLC. So incorporations, corporations, organizations, LLCs, right? Why would they want to organize an LLC in Nevada versus in California? Well, we talked about that $800, I think it's $800, it's $400 to $800 franchise tax every year for an LLC in California, right?
Yeah.
So if they form Nevada, they don't have that expense. It might be cheaper in Nevada. And then there's also we talked about the liability boundaries, right? We're separating our personal assets from our business assets, and we want to protect those business assets from outside liabilities. All right. Well, in places like California, their laws are a lot more creditor friendly than other states. And what I mean by that is, so let's say you get sued. Let's go back to the car accident. Your teenager gets a car accident and someone gets really hurt. Your insurance coverage on the car isn't enough to satisfy the judgment. So they come after you personally for the remainder, right? For the deficiency that the insurance couldn't cover. They're going to look at all of your assets. And one of those assets is your business. Your ownership in that business is a personal asset. It's personal property, right? And so they're going to want that. And in California, they can take it. All right. So in some states, they can actually take that business interest and as their own. And then they can, use it to, who knows, liquidate. They might just go and liquidate the business assets and take that to satisfy their judgment. In states like Arizona and Nevada, and Wyoming, there are statutes and rules that are like limited remedy rules is kind of what they're called sometimes. But so what that means is a creditor can't take their ownership away from an LLC member, but all they get is what's called a charging order. Okay, so a charging order, tell you what that means, is it's basically a right to the distributions out of the business. So if you own a business and a creditor gets a charging order against your business, they don't want that, because all it means is that if I choose to distribute money outside of the business, it goes to them instead of me. So what am I going to do? I'm not going to distribute money out of the business, right?
Mm-hmm.
And so they're waiting on you to distribute money out to fulfill their judgment. And actually, they may even be on the hook for taxes on income that they actually haven't received yet. So a lot of creditors don't want that. So what this does, it gives you a little leverage in settlement negotiations. They don't want the charging order. They want to get paid. So they're more willing to work with you to settle the obligation more quickly. So there's some reasons why you might want to form in a different state. If your state doesn't limit the remedies as efficiently as as favorably as other states. Okay. Now, Nevada, a lot of people think, oh, Nevada is awesome. It doesn't have any income taxes. I'm going to go and form my business there because I don't want to pay income tax, where, my state charges 5% or 10% income tax. Well, there's a little bit of an issue with that, because if you live in Arizona or any other state and you form your business in Nevada, however you operate your business in your home state, and so you see clients in your home state, you're servicing clients in your home state, then your home state's going to want taxes on that income. So you have to qualify to do business in that home state, which means that you're going to have to pay income taxes on all that business anyways. So if your whole business is in your own home state, you don't work outside your state, a lot of times it doesn't matter. You're not going to be able to take advantage of the income tax benefits of another state like Nevada.
Mm-hmm.
Okay. However, you may have some clients, there might be some people listening who are solely online, right? Their business is 100% online, meaning they could operate their business from anywhere, all right? So they could be on a beach in Tahiti. As long as they have Wi-Fi, they could do their business all day long there and never leave the beach, right?
The dream.
So, yeah, you know it. So if your business is truly virtual, 100% virtual, then you might be able to take advantage of income tax benefits of a state like Nevada. Now, it's going to require, again, some complications, not complications, but it'll be a little more difficult to maintain, right? Because what you're going to have to do is you're going to have to establish a headquarters in Nevada. You're going to have basically an office there where the phones could be answered, where you can receive mail, not just a PO box, but a mail. You'd have to put your Nevada address on everything and make sure that you only use your Nevada address to show and support that argument that it's a Nevada business. So there's some things to think about. There is hope to take advantage of those income tax rules that Nevada likes to brag about for forming businesses there, but you have to do the analysis on that. Yeah, and so there's some reasons, some thoughts to why and where, but in the most of the time, the proper way to form a business and the easiest way is to do it in your home state. Be the member, actually have your business ownership, especially if you're a single member or just you and your spouse are the only members or shareholders in a business. Don't own those shares outright. Have them owned by your living trust so that your business can continue after you. There won't be any difficulties in running the business or maintaining that business if you become incapacitated or you pass away unexpectedly. You want that if you have the trust, if your living trust owns the business instead of you, then that trust can continue to manage the business in your absence.
That's great advice. I've never thought of that. I think a lot of us just start businesses because, we're ready to get out of the rat race or just not work at a desk. And we don't really think about the exit plan or estate planning in that sense. So I love that tip. So I learned something new.
and real quick with the exit plan, one of the conversations I have up front with all the business owners I work with is that exit plan. It's not just so that we can get a good plan in place for that exit, whether they plan to sell or they want to pass it on to their children or whatever that happens. But again, it's all about a state of mind. It puts you in a different frame of mind. Like I said, creating that entity gets you a little more serious about the business. Having an exit plan gets you a little more serious about the business. You start thinking about this business as something, again, separate from you. You want to put this, it helps you think about putting systems in place and processes in place to where this business could run without you or with someone else with the same aptitude or same experience or same skill set. But really, you become a business owner rather than just someone who owns their own job, right?
Mm-hmm.
You could, then that's when you can take advantage of all the great corporate lifestyle, right? You can be, you can step away, go on vacation, know the business is going to continue to grow and function without you. You can not have to work 80 hours a week. You've got systems in place, which is just a huge benefit. Even if you're not planning on selling the business, it's going to make your life a lot better, and it's going to fulfill those dreams you had about why you started your business in the first place.
I sense that this is going to be its own segment. I don't know. What do you think?
Yeah, I think it sounds great. It's a good one.
Well, I think today was a great starting jump off point for anyone who's just starting out, or maybe you've had your LLC for a while, but you've gotten some gears rolling and you need to speak with someone to see how to take your business to the next level. We do have quite a few more segments. This is going to be coming out bi-weekly. So make sure you hit the subscribe button so you're not missing anything. And before we leave, Todd, if anybody has questions or want to connect with you and maybe hire you, how can they reach and connect with you?
Yeah, that's great. So my firm is Strategic Legal Works. You can get a hold of me at Todd at Strategic Legal Works. You can text or call me. My office number is 520-333-7543. I'm on the firm's on Facebook. I'm on Facebook. Also, just trying to be everywhere and anywhere. So those are kind of some of the really good ways to get a hold of me. So yeah, happy to discuss these. If you have any specific questions that come up, give me a ring. Happy to talk it over with you.
Perfect. And just a reminder, everyone, he's in Arizona time. So be cognizant if you're going to be calling or texting at odd hours of the day. Always shoot for email first and then try to book a call. Well, thank you again, Todd. I can't wait for the rest of our series. And everyone, again, make sure you hit the subscribe button. And if you liked anything or learned anything or had any aha moments, please make sure you put all your comments down below. Everyone, you have a great day.
Awesome. Thank you.